Today, while my video series 74, we shall be discussing the format of the newly introduced company's balance sheet. Today, we will be discussing the ordinary share capital and preference share capital. All companies are incorporated or registered under the Companies Act 2013 or under any other earlier Companies Acts. The earlier Companies Act refers to the Companies Act 1956. All the affairs of the company are governed by the provisions of the Companies Act 2013. A company has a legal existence separate from that of the owners. The company's capital is contributed by a large number of persons. They are called shareholders. The capital of the company is divided into units called shares. As there are a number of shareholders, to manage the affairs of the company, shareholders elect a board of directors who manage the affairs of the company. The shareholders of the company are not personally liable for the debt of the company. In case the company becomes insolvent, the shareholder will lose only the capital they have contributed. The shareholders' personal assets cannot be attached for the debts of the company. That is why the company's liabilities are limited. The companies can be divided into a public company, a private company, or a one-person company, which is shortly known as OPC. A public company is a company which is not a private company. A is a company which is not a subsidiary of a private company. The public company cannot be a subsidiary of another private company. The minimum number of members should be 7 in a public company. There is no limit for the maximum number of members in a public company. Now, when you look at a private company, it is the one by its article of association, one restricts the right to transfer its shares. 2. A private company must have at least 2 persons, except in case of a one-person company. The limits the number of its members to 200. That is, the maximum number of members a private limited company can have is 200. The newly introduced one-person company, or shortly known as OPC, is a company which has only one person as a member. The person should be a natural person. The person should be a resident in India. He only can form a one-person company. The OPC cannot carry out non-banking financial investment activities. Its paid-up share capital is not more than 50 lakhs. That means there is a restriction on its paid-up capital. Its average annual turnover of the last 3 years should not exceed 2 crores. If these conditions are satisfied, it can be called as one-person company. Now we have understood what is a public company or a public limited company, what is a private company or a private limited company, or what is a one-person company. Now let us understand the Companies Act 1956 and the revision in Schedule 6 of the Companies Act 1956. The Companies Act 1956 empowers the central government to regulate the formation, financing, functioning and winding up of companies. In the earlier Companies Act 1956, there was no specific guidelines on the preparation of financial statements for a company. No specific formats were prescribed, were available for preparation of profit and loss statement. It only contained the items to be included therein. The Schedule 6 of the Companies Act 1956 was revised and the revised prescriptions were made effective from the financial year 2011-12. The revised Schedule 6 prescribed a specific format to be used in preparation of profit and loss statement, which means a format has been introduced in the Schedule 6 of the Companies Act 1956, which was revised and made effective from 2011-12. The revised Schedule 6 of the Companies Act 1956 had also done away with the horizontal form of balance sheet and introduced the vertical form of balance sheet. Now for a company, only vertical form of balance sheet and profit and loss accounts are available. The Companies Act 2013 was enacted in 2013. The new Companies Act has come out with a statutory understanding of the various elements of financial statements. When we say financial statements, it includes the balance sheet, the profits and loss account statement, the cash flow statement. The new act says that a set of financial statements in relation to a company includes 1. Balance sheet as at the end of the financial year, profit and loss account for the financial year, income and expenditure account in case of a non-profit company like a charitable institution, education institutions, etc. Cash flow statement for the financial year, a statement of changes in equity if applicable, that if there is a change in the capital composition, that should be made known by way of a statement. Any explanatory note annexed to it or forming part of any document referred in the above clauses. Now let us see what are the amendments which took place in 2015. The Companies Act Amendment Act 2015 was revised with an intent to enable ease of doing business in India. The Parliament had amended certain provisions of the Companies Act 2013, which is known as the Companies Amendment Act 2015. The major changes with respect to credit appraisal are: 1. The requirement of the minimum paid up capital is removed. Earlier there was a stipulation that the minimum paid up capital should be 1 lakh for private and 5 lakh for public companies. The ceiling is removed in the Companies Amendment Act 2015. The requirement of obtaining the certificate of commencement of business is removed. Previously, there was a need for a declaration to be made by the directors that every subscriber to the memorandum of association has paid the required value of shares agreed to be taken by them. This requirement is removed in the Amendment Act 2015. Requirement of common seal has now made optional. Prior to amendment of the Companies Act in 2015, affixation of common seal, which is known as the signature of the company, was mandatory. In the Companies Amendment Act 2015, the requirement or use of the common seal has been made optional. The next one is the holding company can give loan to its wholly owned subsidiary company or provide guarantee or security in respect of any loan taken from a bank or financial institution, provided the subsidiary company utilizes the loan for its principal business. There was a restriction on this in the earlier Companies Act. The next one, a new clause has been introduced with respect to payment of dividend. A new clause is introduced which says that no company shall declare dividend unless carried over previous losses and depreciations not provided for in the previous year or years are set off against the profit of the company for the current year. That is, in a company, had there been any accumulated losses or not making depreciation provision, unless they are clearly set off, no company can declare dividend. Then they have introduced a provision relating to reporting of frauds by auditors, acceptance of deposits by the companies, especially in case of failure of payment, etc. Now, to whom these company acts are applicable? There are a number of non-corporate business entities such as proprietorship, partnership, Hindu undivided family, trust, association, limited liability partnership, etc. These non-corporate entities do not fall under the purview of Companies Act, SEBI, etc. These non-corporate entities are not required to compile their financial statements as per the Companies Act, since they are non-corporate entities. Now let us understand a balance sheet, a broad classification of liabilities and assets as per the latest format introduced in the Companies Act 2013 and 2015. There are two major headings, liabilities and assets. Liabilities are divided into three categories: Shareholders Fund, non-current liability and current liability. The asset side of a balance sheet are divided into non-current assets and current assets. Let us look at the format introduced by the Companies Act 2013 and 2015. There are four columns, the first column being the particulars. Second column is a reference to the note number. Suppose you want to know more about a particular item, you may have to visit the place where the note is given. The next column talks about the figures as at the end of the current reporting period. Similarly, for the purpose of comparing the performance or the value of the previous year, one more column is introduced, figures as at the end of the previous reporting period. So first one is equity and liabilities. First one is shareholders fund. Second one is, as I have said, non-current liabilities. The third one is current liabilities. Now let us move on to the asset side. Non-current assets. Then comes the current assets. Now let us today concentrate on the shareholders fund. In particular, the ordinary share capital and the preference share capital. We will start from the equity side, shareholders funds. Shareholders fund is divided into three categories. 1. Share capital. 2. Reserves and surplus. 3. Money received against share warrants. Why this video series 74? Let us understand the share capital, which is a part of shareholders funds, which appears on the liability side of balance sheet. We know, as per the business entity concept, the owner is a different entity and the business is another entity. So the shareholders fund is a liability for the company. When the business is found up, the company had to return the money to the shareholders. That is the reason why the shareholders fund appeared as a liability in the company's balance sheet. Now, let us understand the classification of the share capital. The share capital of a company is divided into two. One is equity shares, also called as ordinary shares. The other one is preference shares. Let us first go to the equity shares, also known as ordinary shares. According to Section 43 of the Companies Act 2013, an equity share is a share which is not a preference share. So anything other than a preference share is an equity share. In other words, shares which do not enjoy any preferential right in the payment of dividend or repayment of capital are termed as equity or ordinary shares. The persons who contribute money through these shares are called shareholders. The equity shareholders are entitled to share the distributable profit of the company after satisfying the dividend rights of the preference shareholders. The dividend on equity shares is not fixed and it may vary from year to year depending upon the amount of profit available for distribution. So here the preference shareholders, only after paying their dividend, the ordinary shareholders will be paid the dividend if there is adequate profit available for distribution. Now let us understand what is meant by a preference shares. Again, according to Section 43 of the Companies Act 2013, a preference share is one which fulfills the following conditions. Condition number 1, that it carries a preferential right to dividend to be paid either as a fixed amount payable to preference shareholders or an amount calculated by a fixed rate of the nominal value of each share before any dividend is paid to the equity shareholders. Second one, on the winding up of the company, preference shareholders have the preferential right to the repayment of capital before anything is paid to the equity shareholders. Now, what are the different types of preferential shares? One is cumulative preference shares. Second one is non-cumulative preference shares. Number 3 is participating preference shares. Fourth one is non-participating preference share. 4 more types are there. Before going to that, let us understand each one of these. A preference share is cumulative when the arrears of dividend are cumulative and such arrears are paid before paying any dividend to equity shareholders in the case of non-cumulative preference shares. The dividend is only paid out of the profit of each year. If there are no profits in a year, the arrear of the dividend cannot be claimed in the subsequent years. If dividend on the preference share is not paid by the company during a particular year, it lapses. This is applicable in case of a non-cumulative preference share. In case of a cumulative preference share, the shareholders have a right to claim the dividend which were not paid in the preference share in the previous years. In case of a non-cumulative preference share, if they don't have the right to claim the dividend of the previous years. Participating preference shares means the shareholders are entitled to receive fixed rate of dividend on their shares as well as the dividend payable to equity holders. That is, participating preference shares holders get both the types of dividend. That is, what is to be paid to the preference shareholders and what is paid to the equity shareholders. Whereas it is the opposite. Non-participating preference shares are entitled only to the fixed rate of dividend. So we have seen 4 types. One is cumulative, who can claim the arrears of dividend not paid of the previous years. Non-cumulative, who doesn't have the right to claim the arrears of dividend. Participating preference share, who can claim their fixed rate of dividend for the preference shares plus the what is paid to the equity holders. Non-participating preference share, who will get only the fixed rate of preference shareholders dividend. Now the next one is convertible preference shares, non-convertible preference shares, redeemable preference shares, guaranteed preference shares. Let us understand each one of them. Convertible preference shares are those shares which can be converted into equity shares within a certain period. Whereas the non-convertible preference shareholders do not have the right to get converting their shares into equity. Redeemable preference shares have the option of the company to get it removed, redeemed after a particular period of time. Guaranteed preference shareholders carry the right of a fixed dividend even if the company makes no or insufficient profit. That is, irrespective of whether the company makes profit or irrespective of whether the company makes insufficient profit, the guaranteed preference shareholders gets the fixed dividend payable to them. Now, issue of equity shares or preference shares at a premium. There are two accounts called equity share premium account or preference share premium account. Sometimes the companies which are performing well and are financially strong may issue ordinary shares and preference shares at a premium at an amount more than the nominal or par value of shares. Thus, when a share, ordinary or preference, of the nominal value of 100 is issued at 115, it is said to have been issued at a premium of 15%. The premium account is credited to a separate account called equity share premium account or preference share premium account respectively. So far what we have understood is, under the shareholders fund, share capital, it consists of ordinary equity share, then preference shares, then equity share premium account, preference share premium account, reserves and surplus, money received against share warrant. In the next video, series 75, we shall continue our discussion on the same topic and understand reserves and surplus, money received against share warrants, share application money pending allotment, which are part of shareholders fund. Subscribe to this channel if you have understood it and liked it, and press the like button and share the channel with other friends. Thank you very much.